Hi everyone, Brian Miller here. I'm the bargaining chair for the West Sonoma County Teachers Association, and I'm here to give you the budget analysis that we just presented the district here on day one of negotiations. So let's get right to it. Point number one, state funding is at historic levels. School Services of California says the term historic is bandied about quite a bit, but it may just be accurate this time. Record one-time funds, record year-over-year ongoing funding. To further that point, the LAO came out in, I believe it's their November report, saying a surge in school and community college funding projected in the upcoming budget cycle. Benefiting from the fastest rise in state revenues in decades, they predicted that you can see here that funding would increase in 21-22 $10 billion and continue to increase out to 2025-26. This second bullet point down, this quote, we believe it's important because these are actually conservative projections. If we go all the way to the bottom of this second quote, it says, "We accounted for the unprecedented nature of economic growth over the past years and assumed that only a portion of that growth would be sustained." So this is the LAO giving a cautious outlook, and we have record funding year after record funding after record funding. So state funding is at historic levels. Point number two, we're too far behind. We're too far behind. Our members are too far behind the state average. If you look at the table, the one there at the top says state high school districts only. That's the average salary for high school districts, the average teacher salary for high school districts. So you have $93,132. In the state, that's all districts. The state of California average teacher salary is $85,856. We're down at $75,689. We've also included Sonoma, Napa, and Marin because the point is our teachers do terribly when compared to other high school teachers. Now, we don't do good against the state in general. Our teachers don't do good when compared to the county, and we're in a county that doesn't do well when compared with other counties. So it's a poor situation that needs to be improved. Point number two, to make it further, here's the historic graph we show of the distance between our salaries and the state of California average salary. And you can see we peaked at the behind in the strike year of 1819. We closed that gap, but then we didn't close it any further. We have got to keep getting closer, and the goal is to get to the state of California average teacher salary. So teachers are too far behind. But point number three is that district funding is not the problem. So these are numbers from 2019-20, which are the most recent ones available on EdData, which is where we pulled all this information. And you can see highlighted in yellow, that's the per ADA funding for the district at $15,565. And the next number over, the 107%, that's percent of average high school districts. That means our per ADA funding is higher than the average high school district. High school districts are up there at the 93,132 figure. And so our bullet point at the bottom in red, I mean, it's a pretty modest statement. I think we could be bolder, but our funding is adequate when compared to state averages. So our salaries are not adequate when compared to state averages, but our funding is. District funding is not the problem. Declining enrollment, a problem? It's not really supported by the numbers. What we have here, the graph on the left is showing total revenues increasing, and the graph on the right is showing average daily attendance decreasing. So if you have fewer students and more money, where's the problem? Furthermore, the governor's proposed budget addresses this concern by changing the way that we get to report ADA. Now, of course, that budget hasn't been, accepted yet, but it's definitely a clear sign that this issue is being addressed, where you can, in this case, average your previous 3 years ADA. Also, the governor's budget proposes taking the COLA up from 2.48% all the way to 5.33%. So declining enrollment is not the problem. Point number 5 is that teachers are inadequately represented in the budget. So on the left, it says people percent of total unrestricted outgo. That is every employee in the district, and that is both health and welfare benefits and salary. That's total people percent of the unrestricted outgo. We're at 80.6%. The state of California average is approximately 86%. So we're lagging by about 5% below the state average. On the right is specifically our bargaining unit and just salary. So that one on the right, where we're 32.3%, the average high school district, according to School Services of California, is 36.68, and we are at 32.3. So let's look at these numbers just a little bit closer. So if we were to go with what is the total unrestricted outgo in our district, that is $953,823. So then 86% of that 13.9 million would be the 12 million, the next number down here. So that's the 12 million is what we would be at if we were at 86%. Our total unrestricted, that's the $11,247,093. So if you subtract those from each other, you get $753,195. That's the investment that would be required in order to get the district as a whole to 86% of its budget at people. That is the shortfall. Let's go look at our bargaining unit, that other graph I had there. So in this case, if we zoom in, we see that the total outgo of the district, now this is 2021 numbers from the unaudited actuals. We have the 27,652,000 number we got up there. So then 36.38% of that 27 million would be 10,142,841. That's that number. Our bargaining unit as of 2021 total was the 8.9 million. So if you subtract where we should be from where we are, you get 1.2 million. That's how much would need to be invested in our bargaining unit's salaries to get us to the state average. That 1.225 million is equivalent to an 11.7% raise, which coincidentally is very close to the percentage needed to get us to the state average. Because our 1% raise is approximately 100,000, it's a little bit more. So every 1% raise teachers get, it's about $100,000 more for the district. Okay, so point 5, teachers inadequately represented in the budget. Point 6, reminding me of like an old friend here with the services and other operating expenses slide, but it's still a problem. It's still way above state averages. It's still a point of contention. Now, the state average for high school districts is all the way down at 10.09. We have learned over the corresponding years and worked with some of the previous CBO is that we as a district do kind of code some of our expenses different than other districts in the state. So it's possible that you might have like 5% just dedicated to that. So, maybe you say the state average, maybe we should think of it as 15. Well, we're still at, we're still 6% above, 7%. I mean, we're too far above. It is a problem that continues, and it still needs to be addressed. In this slide, because I forgot, we forgot to make it purple, so I'm just going to point out where it says budget, those are not real numbers, right? Those are what the district projected when they adopted the budget. Every other number in the slide are actual numbers that were reported after the year closed. So this spike, we don't actually know if the services will end up being 7.1, roughly 7.2 million or not. Okay, point number 7, inaccurate forecasting versus real numbers. You can see these are second interim budget projections. So a district adopts a budget, then does a first interim, and then does a second interim, which comes out in March. So you would think the second interim would be fairly accurate. And you can see it's not. We tend to, we always under project where we're going to go. And some of that is a byproduct of accounting. And we don't expect the CBO to be clairvoyant and guess perfectly every time and know exactly, right? That's not what we're saying here, but we are saying that when you look at those numbers, you have to understand that we are going to end up in a better place than we're being told we're going to end up. Like happens every single year. It's going to happen again next year. And it's not just the ending balance, it's also the revenue. So let's look over here at the revenue. So what we have there in purple are projected budget numbers. So they project the current year, the year after, and the year after that. This table that we have here is the average revenue error from when they projected to when it actually happened. We've been tracking that since about, I think it goes back to 2012 and 13, where we look at, when they made the 2-year. So like in this case, when it actually becomes 2023, 24, we'll go back to this projection, see what the error is, and add that to our percentages over here. So on average, they're 5.6% under when they project their revenue to what the revenue actually ends up being. That's for the year they're budgeting for. The year after that, it's a 12% error. The year after that, a 15.5% error. And so what we're doing here is we're just simply adding those errors back in. So if you just adjust these values for the average error, you get more in line with kind of what we've been seeing, which is this kind of steady increase in revenue. And that looks an awful lot like more of what we should probably expect to be happening when we're seeing record state funding. Point number 8, and there are 11 points, so we're getting there. Employee benefits are not the problem. So one thing you can see, much has been made, certainly in the past, about our benefits. And if you look at the unaudited numbers here, where we got the real numbers, they really basically flatline. I mean, what we had in 2021 is almost exactly what it was in 17-18. Employee benefits, they just have not gone up. The budget line item has not gone up. It was 7.4 million. Now it's 7.5 million. I mean, so it's gone up a little bit, but it's basically holding steady. So employee benefits are not the problem. Of course, we see this new budget projected this year had employee benefits at $8.5 million. So there's this $1 million increase that is a vast departure from historic trends. So we will see, we will certainly in the coming months learn more about why this new projection went up $1 million. But our benefits are not the problem. Point number 9, inadequate total compensation. So down here in this table, we have the average salary, and then we have average benefits, and we add those two together for average total compensation. So we would need a 6.44% raise to get to the state average of total compensation, and a 16% raise to get to the state average for high school districts' total compensation. But it's probably more than that because we actually don't have access to newer numbers for the state than 1920. So this $14,195, that is from the year 1920, and it's actually just for unified districts. We don't have a number for all districts for average benefits. This $15,851 is the average benefits for a high school district, but it was back in 1920. So it's worth noting that these total compensation numbers have probably, well, I mean, have almost certainly, right, increased from the ones we're going here, but this is the most current data we have. So that's what we're going with. Okay, point 10, important point. High school districts on average pay higher. So what we have on the left is the state average for high school districts. It's the raise that we would need to get to that average. So we would need a 23.1% raise. If we had that right now as I'm talking to you, we would be at the state average for high schools. But we're negotiating for next year. So you have to take your current average, but then you have to apply inflation to that value, because you're not negotiating for this year, you're negotiating for next year. So the California CPI, according to School Services January 2021 dartboard, is 5.8%, meaning it would be reasonable for us to ask for a 28.9% raise this year, because that would put us at the state high school average salary, as well as adjust that for inflation so it's ready to go for next year. The table we have on the right, 13.4%, that is the raise required to get the state of California average teacher salary. That's for all districts. Right below, we have the Bay Area CPI, which we get from the Bureau of Labor Statistics, and this is in December of 2021. It was 4.2%. So we add those two numbers together, and we get 17.6, meaning it's also reasonable for us to ask for a 17.6% raise, because that gets us to the state average of all districts, and it includes the Bay Area CPI. Now, the reason we've included two different measures of inflation is more for consistency, because we always have used the Bay Area CPI, which is 4.2. Now, right now, the California CPI would be more advantageous for us, but just kind of as consistency of argument, since we've always used the Bay Area CPI, we just stuck with it on the right, because we also historically have gone for the state average rather than the state high school average. So that's why we're showing two different numbers there. And the last point is that districts around the country are investing in their teachers. And this is very small font. It's not really meant for you to read each and every one, but just get a kind of a big overlook that these are our competition for teachers, right? I mean, this is a slide that's about the budget situation. So I haven't talked a lot about the recruiting crisis, the retention crisis that we're having, but that is in the air. I mean, we have got to make sure that, much like the districts around us are doing, that we are addressing this problem of this very high cost of living and this low average salary. We know that, and we're here, and we just highlighted that we've been there before. We've invested in our teachers before when the financial state budget wasn't nearly as good as it is now, and it's time to do that again. So our closing statement is we should focus our efforts on recruiting and retaining the best educators for our students, and let's use the flexibility provided by an all-time high budget to give our members the raise they need. Thank you.